If you know me, if you've seen some of my recent videos, you probably are familiar with this trend. It seems like we're doing this every single day now. We check the earnings, we look at the stocks and their reactions to it, and we see the companies down double digits. When I reported Google, which is a company I own, as you can see from my holdings here, it went down about 10% off the back of its earnings. We checked out Meta, which is not one that I own, went down over 20% off the back of its earnings, and Amazon, as of the time of me filming, is down 11.6% in the after hours, and I'm not sure where this company is going to finish out. At one point during the lows of this recent quarterly report that just came out, the company was down 21% off the back of this. So this is a huge move for Amazon. And this is not common to see a company of this size moving at this scale. Now, if you know me, you know that I'm an investor in Amazon. It's a company that I own. It's one that I'm very bullish on, and it's the second largest holding in my portfolio, as you can see from this right here. As you can see on my holdings tab, it's making up about 28.5% of my portfolio, and it's one that I'm very excited about. Now, we're going to go over in this video all the things Amazon, everything that's related to this earnings report. There's some really good, there's some really bad, and overall for me as an investor, for someone who's very bullish and very excited about owning a piece of this company, it is not one that I'm super excited about with this earnings report, and I do think it deserved to go down. Now, it was down a ridiculous 20+% in the after hours. I don't think that was deserved, but being down about 12% in the after hours, I think is pretty reasonable considering the circumstances. And we'll go over in this video exactly what those circumstances are, looking at the top line revenues, the bottom line profits, shares outstanding, balance sheet, capital expenditures, and all types of fun stuff like that. So if you want to see all that good stuff on Amazon, go ahead and stay tuned. Thank you guys so much for tuning in. If you've never seen me before, my name is Jordan, the Millennial Investor. Here's my portfolio balance as of the time of me filming. My balance and performance since joining this brokerage back when I joined it a couple years ago. And then this is my M1 Finance portfolio, which are shared down below in the description. So check that out and get signed up with M1 Finance if you're interested, and you get $10 for doing so. So thank you so much for tuning in. And without further ado, let's go ahead and look at the top line revenue. The revenue growth is one of the most important things that a lot of investors tend to focus on, and the revenue growth was great. It came in at $127.1 billion, which is a 14.7% growth year over year. This company's last year revenue during the same time period was $110 billion, so they grew revenue about $17 billion in a year over year period, which is awesome to see. So very good numbers in terms of its top line revenue, but the issue is that when we get to the segment in revenue, when we get to these little categories here, you can see that some of the revenue growth was only in specific categories. So for example, let's look at net sales compared to this quarter versus last year, which is North America where the big bulk of this revenue growth came from. You see a $13 billion increase came from their net sales in North America, which includes their e-commerce business, Amazon Prime, and pretty much everything that Amazon owns, including Twitch and their Amazon Fresh stores and all that good stuff. Now, if you look at their international net sales, last year was $29 billion. This year it decreased about $2 billion, about 1.4 to be exact, down to 27.7. Not good. Not only did revenue decrease, but profits decreased significantly. They were already losing money last year. They over doubled their losses this year, which is not good. And the profitability the same for North America. They put up a small profit last year. This year they put up a small loss. Now the one concerning part here in terms of their revenue growth, if you only look at this number, it's very important as an Amazon shareholder, don't get me wrong, and I think that that's a big part of this company. But you notice in my spreadsheet here, I have it segmented out into 4 little segments. The first one being the annual revenue growth, just the overall company. NA for North America, I for international, and then the most important part of the business, in my opinion, which is AWS. AWS is the most resilient, most fast-growing, and most high profitability segment of Amazon. And if we look at that category, it did grow. It grew from $16 billion to $20 billion, which is still pretty impressive growth, but their costs are skyrocketing alongside it. Their operating income barely grew on a year-over-year basis. And you can see that from my spreadsheet. If you look here, you can see that revenue grew about 27% year over year. Let's go ahead and zoom in so you all can get a little bit of a better view. There we go. That's probably a little bit better. You can see that they went from $20 billion, and that's about a 27% revenue growth, which is good, but when you compare that to some of the last couple of years, consistently it's been growing anywhere around 30 to 40%. So 27% revenue growth is pretty much the slowest number it's ever put up. And then the profit margins is where it's really starting to get concerning. Generally, the profit margins have been going up, and over the last couple of years, it's gotten pretty good. So you see in 2020, the average profit margin was right around 30%. In 2021, The average profit margin, which increased again, went up to 30.9%. This quarter, they put up 26%, which went down. Which, by the way, the only thing I don't have yet, which they'll release tomorrow on their 10Q, is their AWS backlog. This is the chart that I always update every single quarter. I do not have those backlog numbers yet, so I'll update that in the next video. But you get the point. You can see that the revenue is growing. It's growing quite nice. But really, the margins are really starting to get compressed, and they're doing everything possible to keep this revenue chart going. Now, they're projecting a pretty reasonable growth rate. They're going to finish out the year at about 8% growth. Not bad, not amazing, but it's pretty average considering that we're in a recession, and it's nothing to complain about, and I really want to see these profit margins go up. Now, in terms of what the company's actually doing, I could sit here all day for hours and go line by line, and what I'm going to do is I'm going to slowly scroll through, and if you want to read over this yourself, you can pause the video, but I just want to go over some of the highlights and name some of the ones that I think are interesting. So to start off, they did start their new Lord of the Rings series. That did start this past quarter. Thursday Night Football kicked off, and it was a huge success. They got tons of Prime members off of that, and they're also getting exclusive rights to Black Friday football, and then they also had a second Prime Day, which did premiere in October, which was the fourth quarter, which was brand new, and they are also opting into Venmo as a payment option, and they are also expanding their business partnerships with AWS, which it talks more about that later on. It talks about BMW, it talks about expanding its deals with CrowdStrike, which you can see right here. Its ecosystem partner CrowdStrike did expand by running, building, and securing applications with AWS software. They talk about expanding the Echo Dot and clock feature, and their Kindle service is expanding. And you get the point. We can scroll down here, and I'll go ahead and speed up the little scrolling speed here a little bit. So you can see all the stuff that Amazon is doing to innovate and continually expand their business. You get the point. You can see that even though in a recession, we can continue to grow at 15+% growth rates in this quarter, and for the year, we're going to finish out at about 8%. Now, while the profit margins are not very good, the operating margins are not good at all, it is good to see that this company is still innovating and finding ways to grow. And the reason that they're finding ways to grow is because this company spends ridiculous amounts of money on capital expenditures. Let me give you an example real quick before I show you the numbers, just so you can see how ridiculously comparable this number is. We were talking yesterday about Meta, and I said, man, that company Meta is spending so much on CapEx, it's just crazy. And they have skyrocketed, basically doubled their CapEx in the last 6 months. They're now spending about $9.4 billion a quarter. So remember that number. Remember that number in your head really quick. $9 billion a quarter. Pretty crazy, right? $9 billion every quarter is pretty high, but that's nothing when you compare to Amazon's most recent, as we can find their capital expenditures in the most recent quarter was $16 billion. Almost double that of Meta, which is already an extremely high number. Look at this CapEx skyrocketing. By the way, that's one of the only numbers that didn't pull up in the most recent quarter. It's not populating here into Qualtrim. It'll be showing up later today. But you can see that they spent over $16 billion in the most recent quarter. And I have to wonder, where's it all going? If you look on an annual basis, that's when this really becomes apparent. Jumping into the annual charts here and looking at the CapEx, you can see that it went in a 2-year period from $16 billion up to $40 billion, up to last year's $61 billion. And this year, they're on track to outpace that. If you look at where they're at today, and this quarter, they spent $16.3 billion. Let me go ahead and zoom in a bit here. They spent $16.3 billion in CapEx versus last year's $15.7, already an increase. And on a rolling trailing 12-month basis, you can see in the last 12 months, last year, they spent $56 billion. So far this year, in the last 12 months, they've spent $66, which is already on track to beat what they spent last year. But where is it all going? I mean, don't get me wrong. I know this company owns a lot of buildings. They're buying planes. They're buying other businesses. They're buying iRobot, One Health, and all these other companies. But where's it all going? I mean, good Lord, $60 billion in CapEx? What is this company buying? I honest to God, I feel like Amazon is trying to buy the globe, the entire world. As sooner or later, Amazon is going to own a stake of your blood. They're going to have like a pint of everyone's blood from all this CapEx. What are they spending $60 billion a year for? I know that this company is constantly reinvesting back into itself, and I do know that eventually this will come to an end. The CapEx will flatten out profit margins will return. But in the meantime, you get to see this cash pile dwindle as this company reinvests back into itself so aggressive that it's just crazy. The one thing that is a bit concerning to me, it's not a huge deal because this company is still very, very financially healthy and they're so dominant. It's not a big thing, but it is important to notice, and I don't like it. They have debt that has gone up. It's now at $59 billion in debt, and their cash has decreased more and more to where they have about the same amount of cash versus debt. If you look at these overlaid over each other, you can see that generally the cash has outpaced the speed of that of the debt, and now as of the most recent quarter, they're almost identical. They sit line by line. So that's still fine. This company's not highly levered. They could pay off all their debt tomorrow and they'd be perfectly fine, but it's not good to see because I want to see cash piles that are trending up over time and debt piles that are trending down. So I didn't like that part of this earnings report either. Furthermore, the shares outstanding. This company announced a share buyback program, and last quarter, for the first time ever, we saw shares go down for the first time in basically a decade, and went from 10.18 billion down to 10.175, a teeny little trickle down. Well, it continued and reversed that trend up to 10.191, which basically just got rid of all those shares they bought back, as I'm assuming they bought back hardly any this quarter. And then the last thing I wanted to take a look at was free cash flow. We've talked about this before, but this company's free cash flow, which was growing and going into the positive, is now turning negative and is going tens of billions of dollars into the negative. It's so shocking to see a reversal in a chart like this. You can see that the chart, generally speaking, over the last decade has been on an uptrend. What was originally producing very little cash flow relative to the company's size began to skyrocket and go sky high, hitting $25 billion in 2020, and then going to negative 14 in 2021. And then so far in 2022, we're not stopping that trend. We're going still far into the negative, and that's still a little bit concerning. So overall, how do I feel about this earnings report? As a shareholder, what do I think? Well, the good thing is we're still seeing revenue growth. AWS is still growing quite nice. Now, I know that we're in a recession, so I'm trying to be generous here. 27% revenue growth still is incredible. Negative 5% on the international and 20% growth on the top line for North America. So this company is growing. 15% year-over-year growth in a recession, I am not going to complain about. And I do think that that is a good part of the company. I do think that they're still dominating. They still have a great moat. And the margins aren't bad, but gosh, it's not good to see the international and the North America sector now both being negative, so I don't like to see that. And really, these AWS margins are the only thing I'm concerned about. It's went down from the previous 35% at the beginning of the year, now down to 26%. So it's still very profitable, and that's awesome, but I don't like to see it going down as much as it is. Now, overall, I'm not worried about it. I'm long-term investing into Amazon. This is a long-term hold for me. I don't plan on selling my shares, so that's not going to be an issue. But I do think this drop of a massive 12, 20%, whatever it shakes out tomorrow, I do think it is somewhat deserved. I don't think the company needs to go down 20%, but I do think a 10% downturn is likely deserved when a company of this size continues to put up more and more losses despite their incredible multi-trillion-dollar size. So I do think Amazon does have some recovering to do in terms of their business model. I think that they need to get back to a little bit of a margin story, but Amazon is always in a constant reinvestment phase. Who knows when that ends? Maybe it never ends. Maybe it goes on for the next 100 years. But at some point, Amazon will start to realize some sort of margin, and when they do, I think that the profits will be astronomically large. But in the meantime, shareholders do have to bite the bullet and put up with earnings reports like this, which is something I know I will have to do as an Amazon shareholder. And in the meantime, I'll just continue holding my shares. I'll continue to keep it as a big position in my portfolio. I don't plan on buying any extra. I don't plan on selling any, but I just plan on keeping it at the second largest position in my portfolio, right at around 30% or so of my holdings. But other than that, guys, thank you so much for watching. Let me know if you're an Amazon shareholder and how you felt about this earnings report. But other than that, guys, check out all the stuff down below. Get signed up with them on Finance for a free $10, and I'll catch you guys next time.